Good day, all. Ira Epstein of Linn Associates with your financial market wrap-up, and this is for Thursday, the 11th of April, 2019, and we're getting on to 4:40 in the afternoon. That's p.m. Central Daylight Time. Look at all the red behind me. A down day. But let me tell you one of the things I'm noticing, and it doesn't matter the market that I'm looking at. I was having an office meeting today. I'm saying, is anybody here noticing the sudden lack of follow-through? That the markets try to break out to the upside, they immediately fall back. Coffee's a great example of that. Recently, I had a signal in the Dow where it lost its upside momentum, and I'll show you that in a second, whereas the others were still pretty strong. They hadn't lost it. In fact, they still haven't. The tug of war goes on, so which side starts winning out? Same thing in the nat gas, I'm noticing. The market failed after it lost a bearish embedded reading to go up back to its 18-day average. So we're in one of these strange periods. We're in a period where also interest rates moving back higher, even though the Fed is staying on hold. It's confusing for traders, but the moves aren't all that big. They're just more whipsawish than anything else. When we take a look, we are down for the week so far in the S&P 4 points. Nothing. And that's from the highest recent close that we just had. But you feel like there's a weight on the market. When you take a look at the chart action here, as I look at it, we've narrowed into very small ranges. Look at how big they were back here and how narrow everything has gotten right through here. That's why the market is tiring at this point. And I don't mean tiring to the upside, I just mean tiring out if you're trying to watch it, trying to figure out which way it's going. The pattern is still one, though, of higher lows and higher highs. Therefore, it is still in a bull. The market is still over the 18-day average of closes, and my definition of bias in the market is if the market is over that number, it has upside bias. Under it, it's got bearish bias. Now, let's assume the market gets the power to drop 13 points and take out 28.78, the last break low. What that would do in the market, it might set up a challenge of the 28.55 level, the 18-day average, but it's not acting like a market here that wants to just collapse on you. It could happen, but I'm not seeing it. What about resistance? Well, you had been hitting the upper Bollinger Band. It's still traveling higher, so it's further away from the market at the old highs, nearly at 29.20, and momentum is still bullish until the red line closes under 80. As tiring as you are looking at it, the market's still in the bull camp. So this chart on all cylinders is still very much alive. If it took out 28.78 and it kept the embedded reading, it would still be bullish. This rules the day, not the swing line. When we come to the NASDAQ, you have the fully embedded reading. The market ranges have narrowed in rather sharply, but it is still the pattern of higher lows, higher highs. The number here that you'd be watching is 75.75.50. If that were taken out, that would be the first sign of a higher high and a lower low. But it is not ruling the chart. This is ruling the chart. As long as it's embedded, the pullbacks in the market, in my opinion, are still being controlled by who? The bulls. The market that lost its upside momentum, and I've been looking for price to hit the 18-day average of closes, was when this happened and you lost the embedded reading right through here. You had it embedded. You had 3 days in a row where the numbers were over the 80 level. See that? When you lose it and don't regain it right away, often price and the 18-day average make a run at each other. So I'm looking for that and the 18-day average to come together. What's been happening is as the quietness has gone on, the 18-day average is flattening out and price can come down to it now at the 26.01 level and satisfy that count. Already it does have a pattern of lower highs and lower lows, which is bearish, but it didn't close under the 18-day average. If it closed under the 18-day average of 26.01, then you'd put into play the possibility you're going to return down to the Bollinger Band and or the 200-day average. The key, though, is the 18-day average. And right now, as you pull back to it, it's still going to be supportive. In the Russell, The market has now got, if we take a look at this, both numbers over 80 today, both over 80, both over 80 the day before and the day before. Not here. So it too has the embedded reading. And yes, it's running into the resistance at the 200-day average, but I'm going to repeat again. 3 of these 4 indices are still very, very much in the bull camp. The Dow is the weakest. The Dow is pulling back to a support level at the 18-day average of closes. In the VIX, the market is just drifting sideways, trendless and oversold. It has a higher high and a lower low, very much in this sideways pattern right now, with the slightest of bent to the downside as I'm looking at it. I've got bad allergies, trying to hold back a cough here. That should be as bad as it is. In the T-bond market, we've got higher lows, higher highs, but you closed under the 18-day average. And are you noticing how often it's hitting that number? This is the type of pattern that wears traders out, me included, because you can't make something out of nothing. The market's lost its volatility. It's just sort of hanging here. Even if it breaks down and gets through the 147.16 level, you don't get a bear signal. You'd have a higher high, lower low in an oversold market. To get a bullish signal, you got to close back over the 148.17 level and not take out 147.16. In the 10-year note, it's just like in the bonds. Look at how you're just wearing yourself out. When this happens in markets, I often tell traders, take a couple of days off. It's probably a market you want to avoid because you get chopped apart for little bitty sums here, and it's frustrating. TLT ended its uptrend, but look what it did. It breaks through the old low, so now it's got a higher high, lower low into a very oversold condition. Don't know what to do with that. In the dollar index, do you recall yesterday we had an outside day down? And what I said was you should not take out the high of an outside day down, otherwise you can get what's called a bear trap, and you put into play the idea that maybe it's going back to the Bollinger Band. Well, you took it out today. So now in order to counter my thinking about getting up here, it would have to get back under yesterday's low. The more important thing is you're just waffling like this and you can see it. Up and down, trying to make something out of nothing, and that's the hardest thing here. When we get to the euro, while the swing line has been up with higher lows, higher highs, it ran yesterday to the 18-day average, today to it, and it's run into a brick wall at that number. Going nowhere. No trend to speak of because the bias is down when you're under the 18-day average. The swing line is up. You lost the embedded reading back here, right there, and the goal was the 18-day average, which it's gone to and run out of momentum. In the British pound, you have a pattern that's got lower highs, lower lows, bearish. The market's got downside bias since it closed under the 18-day average, bearish. But look at how oversold the market is. So that tempers how bearish one might be. If the market wanted to break down, this could be a support level at the 130.28 to 130.10 level, the 100-day average in the Bollinger Band. What about on the upside? Let's assume you took out 131.67. Well, right in front of you is the 18-day average waiting for it. So you'd have to close over this whole thing. If you did that, the odds would favor you get another bullish impetus to the market. Why? Because you'd have higher lows, higher highs over that, and if you could turn up then the slow stochastic to pointing higher, you'd suddenly have the higher momentum and all. But that's a ways off from where you're at, nearly 100 points from here. In the Japanese yen, while we had a downtrend in place, when it took out the high right here, I had said it's run out of its downside. That's over. The question is, can it get anywhere? Look at the 18-day average. Look where you went yesterday. Look what you're doing. You're just fighting against it and drifting. Oversold immediately. It's like a market that wants to frustrate you. In Bitcoin, you lost the pattern of higher lows, higher highs. However, the key is the red line. If the red line closes under 80, then I will look for price in the 18-day average to come together. Suffice to say, this rules the day. Until it's lost, these pullbacks could be false. You've got to keep your eye on that close. Right now it's at 83.35 on the settlement. In the energy sector, you're still under the 18-day average of closes on the differential between the Brent and the WTI crude, which basically keeps the WTI being stronger than the Brent. That's the way to think of that. Now, today we had a break in the market of 90 points in the Brent, but like I keep talking about stochastics, they are the key right here when they embed. If you lose the red line, getting back under 80, then I'll be looking for price in the 18-day average to come for a visit with each other. The same is true of the WTI, and yes, it was down 100 points, but the bulls have stepped in on each of these breaks when it's embedded and driven the market back up. So caution if you're trying to be bearish. It's still very much in the bull camp. 275-point decline in the WTI, but all you did is you were over the Bollinger Band. What's the odds of staying over that? 5% of the time. You were over it the day before it? No, you were one tick under it. So it's just waffling back and forth between over it, under it, but riding it. And it's still very much in the bull camp. And in that gas, this is one of those frustrating markets, because what has now happened is instead of the market getting up to the 18-day average, it did make a run at it, missed it by 90 points, which I don't consider hitting it. That's wide enough away. And now what's happened is you keep dropping that 18-day average. Getting back to it from the original loss zone will not produce, from what I can see, a reasonable acceptance that the market can get there and make somebody something. Here's when you lost it. Right here. This was the day. So on the close, it was 270.80 then. Now you're dropping every day about $1. So tomorrow I'd expect it to be 271.50. So instead of the market running up and getting to it, it could still do that, but there's no money to be made out of it is the point. I find this market very, very difficult right now. In fact, I'm finding so many of them difficult. And traders have to learn to recognize when markets get difficult, you back away for a little bit. Let the trends or the narrowness of no trend start narrowing in, and you get those flat lines on the Bollinger Bands, and you play it accordingly. There's a lot going on, though, in the fundamentals. So what our staff does here is we have a whole staff of writers. And during the day and evening, they're scurrying the market for information. We start actually broadcasting at about 6 in the morning, 6:30, our different research. And I'm talking, you see me holding this up because through our platforms, we also talk. And if you're not around to hear it, it's okay because there's recordings in them. But we write, so that'll be in your mailbox, that'll be in our platforms, along with the oral parts that we're doing. If you haven't tried our research or our platforms, do so. Give us a call or go to our website, www.iraepstein.com. It is not your typical platform. It is not what you've seen elsewhere. I think you're going to find it full of research, full of ideas, and that's basically how we differentiate ourselves. Remember, you can always click up here if you're watching me on YouTube. I'm Ira Epstein. You have a great day.